Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Matt Tuttle, CEO and CIO at Tuttle Capital Management and Managing Director at Access Investments. We're talking about single stock ETFs today, which are the first of their kind listed in the US, though similar products were already on the market in Europe for quite some time. Matt, welcome back. Great to have you on the show.
Hey, thank you for having me.
So this new category of ETFs, single stock ETFs, that made their debut, and Access Investments was the first provider. Earlier this month, Access launched the first suite of 8 single stock leverage and invest ETFs. And this first suite is 2x bull and bear on Pfizer, 2x bull and bear on Nike, 1.5x bull and bear on PayPal, and 1.25x bear on NVIDIA. But the one which saw most interest from investors is TSLQ. This provides -1x, which is inverse exposure to Tesla stock. This has already gathered more than 35 million in assets and has seen incredible volumes in the past few days. So tell us why you decided to launch these ETFs. We know that investors have other ways to gain leverage on a single stock or to short a stock using margin or using options. So what was the need in the market for these products?
Yeah, great question. So, I'm a trader myself. So I always come at everything from the standpoint of there's always times where I'm saying, wow, I wish something like this existed. And single stocks is one of those things. So it is for more sophisticated retail investors, and it's just another tool. So, if you want levered exposure on the long side, you could use margin, or you could buy call options. Not everybody's comfortable using margin. Not everybody can use margin. Not everybody's comfortable buying options. So that's one thing on the long side. On the short side, not everybody's comfortable shorting, and not everyone can short, and people in IRAs can't short. Another thing that's interesting is after hours, options don't trade. So we saw a lot of activity in the inverse Tesla when Tesla announced earnings after hours, and which you would expect. But I also have to figure that a lot of that volume was from people who normally would have bought puts, but because the market was closed, couldn't.
That makes a lot of sense. ETF is a very convenient wrapper. So tell us, how exactly is the exposure achieved in these products? What exactly do these ETFs hold?
Yeah, so quite simply, they hold swaps on the underlying stock that, for the bull ones, give us the long return of the stock, and for the bear ones, give us the short return of the stock. So we've got swap counterparties, and every day we rebalance back to the exposure we need to have.
So in terms of costs, are these products more expensive to use? So supposing someone wants to short Tesla, and you mentioned that shorting is not easy, and most people are not comfortable shorting stocks, and many do not have access to those margin accounts. But supposing a sophisticated trader has access to all those tools and is comfortable using those tools, so which way is more cost effective?
So, that really all depends, because when you're shorting a stock, you've got borrow costs. There may be some other things or whatever broker you're doing, might require or might charge you. typically, I would say, the ETF is going to be, a little more expensive, but it doesn't necessarily have to be. But I would say typically because of the expense ratio, it may be a little more expensive that way.
So how exactly should investors use these products? And investors should remember that these rebalance daily, they reset every day. So these are not buy and hold or buy and forget products. So what kind of usage do you see? What kind of usage do you recommend? Should investors hold these products just for a day or two to bet on earnings or any other corporate event or any other usage that you recommend for these products?
Yeah, so I mean, there are a lot of potential uses. The cool thing about sophisticated retail investors is everyone's got their own kind of strategy. So some people are day traders. So some people might say, hey, I don't like the way Tesla looks. I'm going to short it at 9:30 and I'm going to cover at 4. Other people might have a long-term negative view on Tesla. So you can hold these longer than a day. It's just, once the returns start to compound, your results are going to be or can be different than what you would expect. So, there's so many different uses from, pure intraday to, maybe, you've got a couple of day thesis, maybe you're betting on earnings. There's a whole bunch of things you can do with these. Really anything you could do with an individual stock, you can do a single stock ETFs.
That's helpful. So the surprising thing about these ETFs was that the SEC approved these ETFs, though not exactly in the form that you wanted. For example, you had filed for 2x Tesla. They did not allow that. They allowed 2x products for stocks that are not very volatile. But then after approving these products, they issued a number of warnings. Even Chairman Gary Gensler said that these products present particular risk. He said that in a press conference. Then Commissioner Caroline Crenshaw, she said that she even recommended that agencies should adopt new rules because in the current ETF rule, there is no discussion of single stock ETFs. And then SEC's director for the Office of Investor Education and Advocacy, that is Lori Schock, she also issued warning about volatility of these products. So it was a bit surprising because they let these products come to market and then kind of they were saying that investors maybe should not use these products. So were you surprised that they approved these products at all in the first place?
No, not at all. And obviously we can't really comment a lot on regulations, but at the end of the day, to me, it all comes down to a couple of things. I mean, number one, it's access to more tools. The more tools investors have, to me, the better. But number two, and most important, is education. And we touched on this a drop, a minute or so ago. But levered and inverse products are designed to provide the targeted return over a one-day period. Once those returns start to compound, what you end up with may be more or less than you would have expected. And, to me, we really need to do a really good job hammering that home to investors that, if Tesla is down 20% over a 6-month period, Tesla Q might not be up exactly 20%. It might be up 30%. It might be up 10%. There's just no way to know. So I think that education is critical. The other piece is obviously, if I've got a 2x long, exposure on a single stock and that single stock opens up down 50% on the day, that's a fairly bad day for that product. So, again, it comes down to education. We're big believers that investors should have as many tools as possible. More is better. But we're also a big believer that, we need to educate people on how these things work.
I totally agree with you. Education is very important. So only investors who understand these products and understand how they should be used, they only should be using these products. And having more tools is always good for investors. And in addition to these SEC warnings, there were a number of articles in financial media too. For example, there was an article in Washington Post, single stocks levered ETFs are financial mutants. There was an article in CNN, New Sign of the Market Apocalypse, single stock ETFs, and Wall Street Journal warned the force that can lift stocks but wreck you. So are these products really that risky? Because, leverage and inverse single stock ETFs, ETPs, they have existed in Europe since 2018. Leverage shares there offers 123 single stock ETPs, including many 3X ETFs, including one on Tesla and other popular stocks. Greenwich Shares also has 77 such ETFs, including 3X bull and bear ETFs. These don't have a ton of assets. Leverage shares have about 135 million, and Greenwich Shares has about 114 million. That is according to the Financial Times. So were you surprised by all these articles in financial media?
No, not at all. We had the exact same thing happen when we launched SARK. And then it went on to, at its height, have about 500 million in assets. And for the first half of the year, it was the number 2 top performing non-levered ETF. So, but we heard the same thing. This is a sign of the top. This is dangerous. These things shouldn't be there. And I can't tell you how many, messages I got from people saying, you saved my account. You're the only thing green in my account. So, we heard the same things. I mean, whenever there's innovation, whenever someone comes out with something for the very first time, there's going to be attacks and so not surprised in any way, shape, or form.
Right. So there are many other products in the market which are much more riskier than single stock ETFs. And I don't see a scenario when these products could pose any systemic risk, unless, of course, one of these suddenly becomes too big. And that may not really happen. So since you mentioned SARK, let's talk about that. So you launched SARK, which is inverse ARK ETF. It provides 1x inverse exposure to ARKK, which is Cathie Wood's flagship ETF. This was launched in November. And as you mentioned, this was one of the best performing ETFs of the first half of this year when most other asset classes had terrible returns. And this quickly gathered more than 400 million in assets. So this was almost perfect timing for this ETF. And then recently, I think in May, you launched 2x ARKK ETF TARK. So tell us why you decided to launch TARK now. Why did you not launch TARK along with SARK? Was it just lucky market timing for you, or was it expressing a market view that you saw a lot of froth in the market then, and now you think the worst is over, maybe time to buy?
Yeah, so I mean, definitely the latter. So when one of the reasons why we really wanted to do SARK was we were seeing what was going on in the market. And we knew that there was going to be some turmoil. We didn't expect the level that we saw, but we knew there was going to be some turmoil. We always planned on doing TARK, but instead of launching them at the same time and, having SARK come out in a great environment and TARK not in such a great environment, we waited and launched in May. And while I'm not so sure that this is the bottom of the market yet, I think we can probably see the bottom from here. So, I'm definitely not, pounding the table, hey, everybody sell SARK and buy TARK. But I think this is a much better time to launch TARK than it would have been if we had done it in November, and that was the plan.
Very interesting and great timing again. So you got SEC approval for 18 such products. So what are your plans? How many more are you launching in the coming months? And as far as the market for these products is concerned, many other providers have filed for these ETFs. Another provider launched an ETF, a similar ETF recently. So there are about 4,000 stocks. So the limit for the number of such products there's no limit. So how many products do you foresee in the market in the coming months and years? And what kind of interest do you expect from investors?
So, it's hard to say. There are a bunch of products that have been filed. I think I saw some statistic that there were like 90 to 100 that had been filed for. And I think some of those are going to launch. I think the providers will probably, do what we did and say, hey, let's start with a group. Let's see where the interest is. Because again, this is an entirely new marketplace in the US. I could see this being massive and taking off, or I could see this be the thing where you've got, a couple of names like Tesla that have a lot of interest, and then maybe, a group of names that have less interest. I know our plans are to file for a whole lot more. And again, we'll kind of be watching, all right, what comes out, what leverage levels are there. What's the interest? What are we hearing from people? We do plan on launching more. I'm just not sure yet at this point. It's so new in the process how many more we're going to launch.
Very interesting. That's all we have time for today. Matt, thank you so much for joining us and congratulations on the launch.
Thank you for having me.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.